But let's talk about the permanent portfolio, because annualized, and I know it's kind of a little bit cheating, but compared to where the S&P is right now, it's outperforming 5-1. Mm-hmm. So can we go over that a little bit just one more time?
Yeah. So right now, the total return on the permanent portfolio is we're right around 5%. Okay, which doesn't sound like much, but the S&P is down 5% in the same period. So the spread is 10 percentage points. That's a lot.
That's big.
And what the permanent portfolio does is it puts your assets into 4 buckets. You have equities, and so if you look at our equities, we're investing in companies that have the ability to compound capital at rates higher than the market's average, where the valuation is much lower than the market, and most importantly, the volatility is very low. So if you look at our companies in there, you're going to find names that you know. McDonald's, Coca-Cola, these Philip Morris. These are very low volatility, very high quality businesses. But that's only 25% of the portfolio. The other 25%, the next bucket, is property and casualty insurance.
That's a big one.
These companies have a big structural advantage because you have to pay your premiums up front. Mm-hmm. And so you look at the performance of a company like W.R. Berkley, like Progressive. These are companies that can do well, whether there's a recession, whether there's tariffs. Everyone's got to pay for insurance. Mm-hmm. Insurance is the oldest form of finance. It's going to be around. And we don't invest in insurance just because we want to invest in insurance. We invest in insurance because that 25% bucket is designed to be bonds. Well, why are we buying insurance companies? Well, because if you look carefully, an insurance company is just a big pile of bonds. So if you look, for example, at W.R. Berkley, it's about a $20 billion business. You look on their balance sheet, guess what? They own $20 billion worth of bonds. The market values the insurance companies on the basis of their bond holdings. So this is a smarter way to buy bonds, buying bonds through insurance companies. So we've got stocks and we've got bonds, 25%, 25%. Mm-hmm. The third bucket is what I call real money. And you want to have real money because you have no idea what the dollar is going to be worth. You live in Colombia. Yep. You're used to seeing the peso bounce all around.
Oh, yeah.
Americans don't think about that as much, but they should.
They should.
So we have a bucket for real money. Now, with Bitcoin, there's a new kind of real money. Mm-hmm. And so the way I have it broken down in the permanent portfolio is in the real money bucket, we've got gold. We've got a gold streamer, Franco-Nevada, mm-hmm. which is a way of owning gold. And then we've got Bitcoin. So you've got 3 things there that are your real money bucket. So now we've got stocks, we've got bonds, we've got real money. And then the last thing we've got is just short-term treasury bills.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.